Hello, good afternoon, and welcome to today's episode of Modesty's Mortgage Masterclass. It's another Wednesday, it's another opportunity for us to educate ourselves and learn a thing or two around the world of mortgages. And I'm very much willing to lead that, and I'm very much willing to offer you that knowledge. So, how are you doing? I hope you're all well and you're all keeping safe. Here in the UK, things are easing off a little bit. The lockdown is being eased. A lot of economic activities are returning to the high streets. Still, some sectors are yet to fully reopen. Like the barber shop, like you can see, yet to reopen. The gyms, the restaurants, the cinemas. So things like that. But then we crack on and we carry on. All right, so today we're going to be continuing on the series that we've been on for some weeks now, which we've been talking about different types of borrowers. This is part 7 of that. Can you imagine that? So it looks like for the past 7 weeks we've just been talking about different types of borrowers. That gives you an indication of how wide this area of the mortgage education is. So it's really important that we dive deep into this and understand it very much, so that because people fall into different categories of mortgage borrowers. So I remain your man, Ikenna Omezudike. I'm here to bring you that knowledge today, and I'm the director of Modesty Financial Consultants Limited, a financial services company based in Luton, United Kingdom, offering mortgage services, investment advisory services, financial advisory services, and financial consulting. So, like we always do, before we go straight into the topic, let's look at what the updates are in the mortgage market or in the property sector in the UK. And please, whatever information I'm giving to you is particular to the UK market. I don't know where you are listening from, so I'm not going to be referring to your own market. I'm going to be talking about the market I know and the market I'm specialized in, which is the UK mortgage and property market. Okay, so there's been a question that's been on, making the rounds this week, and that question has been around house prices in the UK, and the question has been, are UK house prices really gonna fall by 5% at the end of the year and not recover until 2022? Are UK house prices gonna fall by as much as 5% this year and not recover fully until 2022? It's got a question mark. So where has this question popped up from, and why is this question all of a sudden making the rounds in the property and mortgage market? So it's emanated from the poll that was done by Reuters. Reuters are a news agency. So they did a poll among some property analysts about the UK property market and where they see it and how they see it performing and what they see it doing. And I think they polled 21 analysts. And majority of the 21 analysts said that they think the UK house prices are going to fall by as much as 5% by the end of this year, and it's not going to recover fully by 2022. So that forecast was driven by the effects, or the foreseen effects, of unemployment on the UK housing markets post-pandemic, post-lockdown. So the idea is that after the lockdown, a lot of companies are going to go out of business. A lot of people are going to lose their jobs. There will be a lot of, there will be high unemployment in the UK market. And, because of that, it's going to affect house prices. Usually, in a period of high unemployment, the house prices are affected because people need jobs to buy homes. And if people are not feeling secure about their jobs, they are not ready to splash out and make big commitments like house purchases. So there's usually that correlation between unemployment and house prices. So these analysts, their forecast is based on that assumption. Already, in 1 month alone, there's been reported 600,000 job losses, in 1 month alone, post lockdown. And already a lot of people are beginning to feel insecure about their jobs, and they are thinking, well, I don't think things are going to remain the same. But then it was on the back of this fear that the analysts, predicted or forecast that the UK house price is going to fall by as much as 5% this year, and it's not going to make full recovery until 2022. But then in February, before the pandemic, these same analysts, forecasted that the UK house prices was going to grow by 2% this year, and then by 2.8% in 2021. I'm going to, quote one of the analysts, Peter Dixon of Commerce Bank. What he said he expects the housing market to be a victim of the scar that will be left on the UK economy as a result of high unemployment after the lockdown, when the real effect of the lockdown starts biting on companies and job losses and job cuts starts happening. So it's all about high unemployment. That's basically the driving force behind this negative forecast of UK house prices falling by as much as 5% at the end of this year. The other factor that contributed to that negative forecast was the issue around Brexit. As we all know, the UK have exited the European Union, but it's not been ratified yet, in the sense that agreements are yet to be reached on how both regions are going to be relating commercially and in terms of trade and business and other aspects. So by December this year, the transition period was supposed to be over. So it's expected by December this year they should sever ties completely with the European Union, subject to agreements. But from the look of things, it doesn't look like much progress has been made in terms of the agreements that needs to be reached before that transition period ends in December. And if that doesn't happen, there is a very possible reality of the UK crashing out without a deal. So a no-deal Brexit is still possible. And the uncertainty surrounding that no-deal Brexit scenario is likely going to affect house prices, according to the analysts who are coming up with this forecast. So these are the things that they have put into consideration before coming to this conclusion, or to this forecast, that the UK house price will be affected by these two major factors, to the point of dropping by 5%, as much as 5% by the end of this year. Now, you might look at 5% as being, insignificant in terms of the number and the percentage. But when it comes to house prices, that's quite significant. And let me put it into context. It means that a property that was supposed to be worth £200,000 is now going to be worth £190,000 if house prices drop by 5%. So it then means that if you were going to pay £200,000 for that property, by the end of this year, going by their forecast, you would be able to pay £190,000 for that property. That's £10,000 off the sale price or the asking price automatically. That's a lot of money to, that's a huge chunk of money to knock off your house price. If you are the owner, if you are the seller, that's a pretty strong blow to your wealth, because a lot of wealth in the UK are built around house price and house valuation. People feel wealthy by virtue of how much their properties are worth. So £10,000 off that wealth or worth is pretty much a big blow to some people. So that's for properties in the £200,000 bracket. I'm just giving that as an example. Okay, now that's the forecast from Reuters. Now let's break this down and let's look into this forecast and see and compare it with reality and see where we are. You see, since the lockdown was lifted in the property sector on the 13th of May, activities in the housing market has picked up significantly, and it hasn't stopped since then. There has been serious increase in demands in rental properties, increase in demand in properties that are on the market for sale. I did talk about, in the last session, I did discuss the 1 month data that was released by Rightmove, which showed that about 40,000 houses were sold, within that 1 month, and activities have picked up. Agents have never been this busy. Estate agents, I mean, they've never been this busy. As mortgage brokers, we've been very busy as well, because demands and requests have been coming in, people wanting to buy properties. So since the lockdown was lifted in the property sector, activities and asking prices has jumped up as well. In fact, the data released by Zoopla as of this morning shows that asking prices for houses have risen by 2.4% on annual basis. That is compared to this time to May last year. So by May, compared to May last year, there has been 2.4% increase in asking prices compared to May last year. That's the latest data released by Zoopla this morning. So that really shows that there has been activity and there have been increase in asking prices. And last week I did mention that those asking prices were met 98% of the time by the buyers, meaning that on 98% of the occasion, buyers agreed with the seller's asking price and they were willing to meet it and pay it on 98% of the time. So that just leaves you with just 2% of houses that were sold, or the asking prices were not met when they were sold, or they were withdrawn or something. But on 98% of the occasion, the asking prices were met. What does that show you? There are willing buyers, because demand, continues to outstrip the supply in the housing market. And as long as the demand is still very strong, it is very difficult to say that that particular sector is going to crash, because it is demand that drives the activity in that sector. So if demand is strong, basically things are going in the right direction as far as that sector is concerned. So, and then I did mention, I think it was last week as well, that even though with the pandemic, a lot of people have been negatively affected financially by the pandemic, but also there is this feeling of wealth among people. People are feeling a little bit wealthy because people are on furlough who are not going to work, and they receive 80% of their wages from the government, subject to a maximum of £2,500. And these people don't go to work, so their expenditures on transport and traveling, there are no restaurants open, so they don't even go out to spend money on socials. They don't buy clothes and all that. So for those 3 months, they've been receiving money from the government. All they've been doing is been shopping online. Amazon has been very busy. Online businesses have been booming, throughout this pandemic, because people sit down on home, and if they be followed, and the government is paying them 80%, and then if their employer is making up the remaining 20%, it means they are receiving this money. They're not going to work. They're not spending that much. So there is a lot more disposable income in their bank balance than it used to be when they were going to work. That's strange, isn't it? And then on top of that, I did mention all the government interventions that has happened. And most recently, the bounce back loan that people have been receiving and businesses have been receiving, up to £50,000. That has been the easiest business loan I've ever seen people receive in this country. I know I haven't been here too long. At least I've been here for more than 13 years. In my 13 years of being here, I have never seen an easier way to obtain a business loan up to £50,000. So a lot of business owners have received that bounce back loan, and a lot of them are investing that bounce back loan, and a lot of those bounce back loans are being invested or reinvested in the property sector. Some people take that bounce back loan and then they take some part of it and they buy property and they invest in property. So the demand for properties and the demand for houses is still very, very strong, because this feeling of wealth and these monies that are being pumped into the economy via the government interventions to ease the lockdown effects, it's making people feel very wealthy. So what we are seeing on ground and in reality is very different from what the analysts are forecasting. Okay, we are seeing a market on the up rather than a market on the downward spiral. We are seeing a market with strong demand rather than a market that lacks demand. We are seeing a market that the house prices are increasing rather than decreasing. We are seeing a market where the stakeholders are very busy rather than lack of activity. So it's very different from what the analysts are forecasting, based on what is on ground and the reality. But so and a lot of estate agents, which I am one of them, would agree with me that this is not really the reality. Now, according to one of the leading estate agent directors, so Bentham and Eves Estate Agents, their director echoes the same thing that we have been saying, as I said, that look, 5% drop in house price by the end of the year, that is really unrealistic. That is really, we don't see that happening. It will take a catastrophic destruction of the markets, really, for that to happen. It will take such a catastrophic effect in the market to experience or to witness a 5% drop in UK house prices. So even with the lockdown and the uncertainty surrounding the pandemic and everything, year on year, the UK house price has increased, just like Zoopla confirmed this morning, by 2.4%. So even with the pandemic and with all the uncertainty, UK house price has increased by 2.4% year on year, as confirmed by Zoopla this morning. So but the thing is, the data we have, even though it's short term, and compared to month by month data, it's not long enough to basically say that this is going to be sustained. We have seen, say, 6 weeks of activity in the housing market, and in those 6 weeks we have seen strong demands. We have seen increase in asking prices. We have seen asking prices being met by buyers and all that. We have seen estate agents getting very busy and builders return to sites, and everybody in the housing sector getting involved and people wanting to move on. But to be honest with you, we don't think this tempo of demand is going to be sustained till the end of the year. At some point in this year, that tempo is going to drop. That demand is going to ease off a little bit, But because people just, the lockdown was just eased, so there's this upsurge in demand is kind of a reaction to the easing of the lockdown, where people have been eager to get out there and do stuff. And the moment the lockdown was eased, people got out there and they wanted to get on with the deal, do it and complete it. Okay? So, and then because too many people became involved in the housing market at the same time, it kind of drove up the prices. But at this moment in time, things are beginning to ease off a little bit. And towards the end of the year, the upward pressure on the UK house prices will ease off. But it will not fall by as much as 5%, because the activities don't suggest so. And we expect these activities to continue. We expect this upward pressure on the housing price to continue till the end of the year, and it's going to ease off a little bit. But that doesn't mean that there's going to be a sharp decline by as much as 5%. In fact, the analysts said that in the worst case scenario, the UK housing price might fall by as much as 11%. I mean, it will take maybe the apocalypse for that to happen, really. So It is safe to say that the sudden surge in demand that is seen after the lockdown isn't sustainable. That is safe to say that, and normality will return to the market shortly. But one thing we mustn't forget is that Britain is a country of aspirational homeowners. There's a lot of emotional attachment that goes into owning a home in this country. And I don't think that COVID-19 is enough to dampen that emotional attachment and that aspiration. People want to own their own homes in this country. You go to, in some countries like Germany, people don't attach so much importance to owning homes. They are very comfortable, renting properties. Maybe because property rental in Germany, for example, is more regulated than it is here in the UK and in some other parts of the world. But here in the UK, people attach a lot of importance to owning homes. The aspiration of anyone who lives here is to one day own their own home. And that aspiration will continue to drive property activities in this country. Now, also, owing to the fact that people can now see, COVID-19 and the pandemic have taught people a lot of lessons. And one of the biggest lessons it has taught people is that life is for the living, right? And if you don't live it, you will leave it behind. So you see over 40,000 people dying, and a lot of those 40,000 people would have loved to be alive and own a home. And if you're lucky enough to be alive, people are just emotionally thinking, hang on a minute, I'm lucky enough to be alive. I will do whatever it takes to enjoy my life. Even I need to go and buy my own property. I need to go and buy my own house. There is that, urge in people to say, COVID-19 has taught me that anything could have happened. It could have been me. I could have been the one. I could have been among the 40-something thousand people that died in this country. But I'm not. I'm alive, so I'm going to go out there and live life. So no matter what happens, they just want to buy their home, get on with it. They don't care whether it was such a good deal or bad deal. All they know is that I own this house and it is my house. It's one of the things I want to do before I die. That's the way some people see this. And that's the way they approach it. Okay? So do not be alarmed if you are, by the forecast of house prices falling by 5%. If you are a buyer or aspiring buyer, you might find it disappointing. You might be thinking, oh, I was thinking I was just going to wait until this thing happens and I'll buy, properties at the end of the year. Well, if you want to wait, it's your choice. If you want to get on with it, it's your choice. But I'm just here to analyze the data, to analyze the information, and to compare that with what the reality on ground is. And, I leave the decision for you to make and find out where you fall and under what category you fall. Okay? So let's get into today's main topic, where we're talking about restricted borrowers. So we have been discussing in the past weeks people who can borrow. Today we're going to be talking about people who either cannot borrow or who are restricted in their borrowing capacity. So we'll focus on three major groups of people in this category. We're going to talk about the minors, we're going to talk about the mentally incapacitated, and we're going to talk about the undischarged bankrupts and those who are credit impaired. So first of all, we'll talk about the minors. In England, Wales, and Northern Ireland, a minor in the property sector is someone who is under the age of 18. So if you're under the age of 18, you cannot have a stake in a land or in a property or own a legal estate. So you are not legally allowed to own a property if you're a minor in England, Wales, and Northern Ireland. Okay, so on that basis, it includes buying a property and getting a mortgage. So lenders will always ask your date of birth before they enter into any mortgage agreement with you to make sure that you are at that age where you can contract. All right, there are two reasons lenders will want to know your date of birth. First of all, to confirm that you're not a minor. Secondly, to be able to work out what the maximum mortgage term that you can be offered. So if you're like 55 years old and the lender can only allow the borrower to be 75 at the end of the mortgage term, it means they cannot lend you money for more than 20 years. All right, so they will use your date of birth to determine the term of the mortgage that's available for you and to determine whether you are a minor or not. Okay, so minors cannot normally enter into contracts, yeah, except on a contract of necessity. If that contract is not necessary, they cannot enter into a contract. An example of a contract of necessity would be, maybe going into a university or into a college, you can accept terms and conditions, or you want to obtain a mobile phone contract. Yeah, it's a necessity. So things like that you can enter in, but when it comes to property ownership and mortgages, you are not allowed to enter into that contract if you're a minor under the age of 18. In Scotland is different anyway. So this is why mortgages are only offered to people who are 18 years and above. And in fact, some lenders push the minimum age up to 21. They won't offer you a mortgage unless you are up to the age of 21. So the lenders will always check your age before they enter into any mortgage contract with you. Now, in exceptional circumstances where it warrants that this minor is vulnerable, or they need to buy a property for this minor to live in by virtue of what the parents left for them in a will, or by virtue of their entitlement through a will or a trust, the trustee can buy a property on behalf of that minor for the minor to live in, if the trust deed permits that. We've discussed trust before. You can go to my YouTube channel and watch the session we did on trusts. Okay, the second category of people are the mentally incapacitated. People who are mentally incapacitated cannot borrow in their own rights. Somebody has got to do that on their behalf. People who are of unsound mind in England and Wales, they are required to be represented by what we call a deputy. And that deputy is appointed by the Court of Protection. We discussed that when we discussed trustees and when we discussed powers of attorneys as well. So again, go to my YouTube channel, just search Iken Naume Zudike on YouTube. You see avalanche of contents on there discussing some of these issues. So we've discussed powers of attorneys, and we mentioned who deputies are and what they do and how they are appointed. So deputies have to be appointed for people who are of unsound mind if they want to enter into a mortgage contract, and they are appointed by the Court of Protection. So if they set up a proper attorney, people who are of unsound mind, if they set up a proper attorney, they will not be needing the Court of Protection to appoint deputies. They will not be needing that arrangement. So you can look up the previous sessions we've done as well, because the people that they have appointed as their attorneys can actually act on their behalf. Some people set up these powers of attorney when they are still of sound mind, just in case they become of unsound mind. They have appointed somebody they trust as their attorney to make decisions on their behalf. Okay, so these people, if they are on sound mind, they cannot enter into any contract in their own rights. Now, the third group of people we're going to talk about, we're going to spend a little bit more time talking about them now, are the insolvents and the bankrupt. Okay, now a person is insolvent when two things happen: when their liabilities exceed their assets, number one, and two, when they cannot meet their financial obligations within a reasonable period of those financial obligations falling due. Those are the two occasions that defines insolvency. When your liabilities exceed your assets, that means when what you owe exceeds what you own, you are insolvent. Or when the financial obligations you have, the debts you are owing, you are unable to satisfy them or to meet them within a reasonable period of those debts falling due, you have become insolvent. So according to the Insolvency Act of 1986 in England, Wales, and Northern Ireland, a bankrupt person is someone who is insolvent and has been declared bankrupt by the court, by the county court. If it's in Scotland, it's called the sheriff court, right? So the court in this case will issue a bankruptcy order. So it therefore means that someone could be insolvent, but they are not bankrupt. They are only bankrupt when they are declared bankrupt by a court. So, and it only happens when their creditor or creditors apply for bankruptcy order to the court, or when the person in question applies for bankruptcy order on their own accord. So you can declare yourself bankrupt, or your creditors can declare you bankrupt. So an individual can file for their own bankruptcy. Now, a creditor, somebody you are owing, can only file for bankruptcy order against you if the debt is at least up to 5,000, is at least 5,000 pounds, and that only applies on England, Wales, and Northern Ireland. Okay, when you owe someone at least 5,000 pounds, and you've been unable to pay, that creditor has a right to file bankruptcy against you if they have exhausted every means possible to get you to pay up or to reach an agreement with you to pay. They can file for bankruptcy, meaning that you simply cannot, you are not liquid enough to pay that money. So when somebody is declared bankrupt, their case is referred to a trustee in bankruptcy. What this trustee in bankruptcy does is they liquidate your assets. They sell everything you own. Yeah? And then they pay the court fees first. Yeah, you see the order of payment, making sure that the courts, the government is sorted out, the court fees are paid, and whatever is left, they now use it to pay as much of your debts as possible. Now, as an individual, when a bankruptcy order is filed against you and the court declares you bankrupt, you are allowed to keep some assets. If those assets are critical to you earning a living, and if they are critical to your daily standard of life, of living, okay, you are allowed to hold onto those assets. Say, for example, if you need your car to be able to go to work and come back, and there are no other means of you getting to work and coming back except that car, you can be allowed to keep the car because it's essential to you going to work and earning a living, right? Or your laptop. If without your laptop you cannot function in terms of your work, you are allowed to keep the laptop because it is central to your work. So the trustee in bankruptcy will allow that. So they will assess the assets that you have and then liquidate them and allow you to keep the ones that you need to keep. So what it then means is that all your assets, including your property, becomes at risk the moment you are declared bankrupt. Now, in most cases, bankruptcy lasts for 12 months, yeah? But in certain situations, that 12 months can be extended if you have not been cooperating with the trustees who are managing the bankruptcy. So within that 12 months, that bankruptcy, you are currently described as an undischarged bankrupt. Okay, within that 12 months, while the bankruptcy lasts, you are currently described as an undischarged bankrupt. Now, an undischarged bankrupt cannot borrow money, but not totally. I'm going to come to that. So if you're undischarged, the law doesn't prevent you from not borrowing entirely. But then you are not allowed to acquire an interest in a property while you are still undischarged. It then means you cannot buy a property, you cannot get a mortgage. What's the point of buying the property if it will be liquidated anyway? So while you are still in the undischarged bankrupt period, within that 12 months, any asset you acquire then will just go straight into bankruptcy and it will be sold to pay off your creditors. So you are not allowed to acquire an interest in property if you are an undischarged bankrupt. So it means you cannot buy property, you cannot get a mortgage. Now, if the borrowing is not a mortgage, yeah, and it's under £500, an undischarged bankrupt can legally borrow that amount, maybe a credit card or a soft loan. If that borrowing is not a mortgage and it's above £500, you can also legally borrow it, but you are required legally to disclose to the lender that you are an undischarged bankrupt. If you do not do that, you will be held responsible for fraud. It means you obtained the loan by fraud. Now, in terms of disclosure of previous bankruptcy, once you are discharged from bankruptcy, you are entitled to borrow, even though it's going to be a lot tougher to find a lender who will lend to you immediately you are out of your bankruptcy, immediately you are discharged from bankruptcy. So, but you must declare that you've been previously declared bankrupt anytime you go to borrow, even though you've been discharged from that bankruptcy. Failure to do that amounts to, fraud. Now, many lenders will automatically turn down an application from someone who's ever been declared bankrupt. Many lenders will do that. The moment they hear you've been declared bankrupt, they will not want to have anything to do with you. But then, the bankruptcy remains on your credit profile for 6 years. After 6 years, it disappears from your credit profile. So what lenders see on your credit profile are only things that have been there for the past 6 years. Your credit report holds information about you that has been there that has been active for 6 years. After 6 years, it all disappears. But then, if the lender asks that question on the form, whether you've ever been made bankrupt, by law, you are required to declare it, even if it's been more than 6 years, even if it's not appearing on your credit report. Because if it turns out that the lender finds out later on that you've been declared bankrupt in the past, but you didn't declare it, they have a right to recall that loan, and they have a right to hold you responsible for fraud. So if you've ever been made bankrupt and the lender requires that information, by law, you are required to disclose that you've been made bankrupt. Now, because of competition, this space of people who have been declared bankrupt and people who are credit impaired have become a competitive area for mortgage lenders especially. So specialist mortgage lenders have emerged who are comfortable to lend to people who have been discharged from their bankruptcy. Some of these lenders will require that you must have been discharged from bankruptcy for a minimum number of years before they can lend to you. Some will say as long as it's been 12 months, that's fine. Some will even say as long as you've been discharged from bankruptcy in the last 6 months, that's fine. And then as long as you are not owing anything or you've not defaulted on any other credit commitment within the last 12, 24, 36 months, as the case may be. So they can give you conditions, and then the rates you're going to get for mortgage will be higher, a lot higher than what other the conventional borrower would have got. And then you're also going to get a low loan to value mortgage. A lot of the lenders will only do like 75% loan to value mortgage if you have been declared bankrupt or if you've just been discharged from bankruptcy, if it still shows on your credit reports. Some lenders, as long as it's more than 6 years old, that's fine. You are in the mainstream. They are not going to treat you like somebody who's just been discharged. They will give you the normal mortgage that everybody can get. So in essence, lenders treat it case by case, on a case-by-case basis. So we come across these cases and we have access to all the lenders in the market, including those who are willing to lend to people who have been discharged from bankruptcy. Okay, so that's about bankruptcy. Now, when you get that mortgage as someone who's been discharged from bank, even though it's going to be on a high interest rate and low loan to value, this is an indication of how much risk you pose to the lender. By the time they assess you, they will consider you a high risk client. But when you get that mortgage and you, for example, if you fix that mortgage for 2 years, and for that 2 years you kept up paying that mortgage without missing a single payment, at the end of that fixed term of 2 years, and you want to remortgage, you might find that you could get a better deal after that 2 years, because other lenders will be looking at you more favorably and be thinking, he's had a mortgage in the last 2 years and he's managed it fine, so I don't think he's that much of a risk. So it becomes a credit building product for you. So a lot of lenders use that as a credit builder mortgage product to help people build their credits and reintroduce them back into the mainstream. All right, so the next set of credit impaired people we're going to talk about are individual voluntary arrangements and debt relief orders, as IVAs and DROs. Now, you see, not everyone wants to go down the route of bankruptcy. And bankruptcy is like, if you're staging it in categories, bankruptcy is at the top end of credit impairment, followed by IVA, individual voluntary arrangements, and then there is DMP, debt management plan, and then there's the DRO, the debt relief order. So we're going to be talking about the IVA and the DRO, the debt relief order and the IVA. Now, some people may have debts that they can afford to pay it in parts, right? It's not that they can't pay anything, but they can pay something, but not everything. So in that case, an IVA, an individual voluntary arrangement, or a DRO, debt relief order, might be a better way of, getting around it. So an IVA is a formal agreement between a debtor and a creditor to make reduced payments on their credit commitments for an agreed period of time. Usually and typically it's 5 years. So what you're doing in essence is you are saying to the creditor, okay, I'm owing you £10,000, right? Over the next 5 years, I'm going to be paying you £50 every month. That amounts to £600 a year for 5 years. That's £3,000, 5 years. Let's reach an arrangement. Let me make this payment, and after 5 years, you cancel the debt. We declare it, satisfied, and that's what I can afford to pay. It becomes an individual voluntary agreement, usually as a third party who will manage that process, to make sure that process is adhered to by both sides. Okay, so typically at the end of that agreed period, as long as you kept up to that payment plan or payment agreement, after that 5 years, that debt becomes cancelled. Whatever you've paid to that creditor becomes what the creditor gets. That's what they get, nothing more, nothing less. So this is basically similar to debt management plan. But debt management plans are usually managed by third parties. But individual voluntary agreements, it doesn't necessarily require third parties. Sometimes you can do it directly between yourself and the creditor. Okay, so a DRO, debt relief order, is an order that is granted to an individual with debts less than £20,000 and with limited assets. An individual owing less than £20,000 who's got limited assets and who cannot pay their debts. This is an order granted to them by an official receiver. Okay, now this order prevents the creditors, the people they are owing, from pursuing them for that debt without the approval of a court. And this order normally lasts for about 12 months. Okay, so once that DRO is in place, the creditors cannot chase them for that debt for a period of 12 months while that order is in place, while they sort out those debts. It's called a debt relief order. And usually after 12 months, those debts are written off. Okay, so now these actions, whether it's an IVA or a debt relief order or anything, these things, once these orders are placed, they appear on your credit reports. So every lender who makes a search on you will see that arrangement, and it automatically makes you a credit impaired person, right? And it stays on your credit report for at least 6 years as usual. So even when the order is lifted, right, and the debts are cancelled, it still remains on your credit reports for 6 years. Right, and then an IVA or DRO, yeah, they don't legally prevent you from borrowing or from taking a mortgage, but lenders will be very, very cautious. In fact, most of them will be unwilling to lend to you if you are still in the IVA period. If you are still within that 5 years of IVA, some lenders will not lend. But we have some lenders who, I've come across lenders, I've spoken to lenders who know their criteria. And I've dealt with a couple of clients who are in an IVA, and the lenders were willing to lend to them while they are still within that IVA period. As long as they are satisfying that IVA, they can allow them to keep the IVA going, keep paying what you're paying to the other creditors, will give you a mortgage, but the mortgage will be on a reduced loan to value, maybe about 75% loan to value of the property, and then higher interest rate, obviously. So while you still manage your IVA, you can still get the mortgage as long as you have the deposit of 25% to do that. We can give you a mortgage. And then while you do that alongside your IVA, you are building your credits as well. Some other lenders will not touch, no high street lender will touch anyone that is credit impaired. Credit impaired means if you have any dent on your credit report in the last 6 years. Most high street lenders, there are a few things they can overlook, but in most cases, if there is a dent on your credit report in the last 6 years, it will be difficult for them to actually deal with you. But specialist lenders now abound in the mortgage market who are ready to take more risks. And as they take more risks, they charge you more interest rates on that. And then they get what they want in return. And then you get the property you're desiring in return. And then you use that to build your credit report. So while some lenders are not happy to lend to IVA applicants, some are happy to lend to IVA applicants. Now, some other lenders, while dealing with IVA applicants, would insist that you would have finished the IVA, and then maybe a couple of years after you have finished that, then they can lend to you. Some lenders will say, if you have finished the IVA and you have not had any other dent on your credit report in the last 12 or 24 months, yes, then we can lend. But if you have finished the IVA and in the last 12 months you have defaulted on another payment, or you have missed a payment, or you have, had any issues with your credit again in the last 12 months, then sorry, we can't help you. While some will just say satisfactory conduct of the IVA for at least 6 months or 12 months is good enough for them to say, yes, we can lend to you. So it's on case-by-case basis, and it's on individual basis. So when you come to mortgage brokers like ourselves and you say, I've got IVA, so I don't think I stand a chance. No. That you got an IVA doesn't mean you don't stand a chance of getting a mortgage. It simply means your options are limited. Okay? So there are mortgage products in the market there that are called credit builder mortgage products. They are designed for people who have found themselves in financial difficulties, but there's a mortgage product out there to help them rebuild their credit. So we'll devote more time to discussing IVAs and DROs in the future. But for now, for the purpose of this presentation, this is all we can say to you about IVAs and DROs. So I hope this has been useful to you, and I hope you found that educating enough. If you have, please tell us what you think by leaving us a comment, thumbs up, like, share this video on whatever platform you're watching it. If you think somebody else is going to benefit from it, let us know what you think, and let us know how this has been useful to you. And please don't forget to check us out on YouTube and see what we've got in stock for you on YouTube. All our videos that we do live, we do upload them on YouTube for people who prefer to consume that on YouTube, or if you want to go back and refresh your memory on things that we have talked about before. So thank you very much for being here. Thank you very much for staying here with us. God bless you. Have a wonderful day. Take care, and I'll see you again next week. Bye.